What are key considerations for Greeks in calendar spreads? If you are curious about how the Greeks play a role in calendar spreads, you are in the right place. Let's break down the key considerations that traders should keep in mind. Calendar spreads involve buying and selling options that have the same strike price but different expiration dates. Typically, you buy a longer-dated option and sell a shorter-dated option. Understanding the Greeks, delta, gamma, theta, and vega, is essential for managing risk and optimizing your strategy. First, let's talk about delta. Delta measures how sensitive an option's price is to changes in the underlying stock price. In calendar spreads, the net delta is usually close to zero at the start because the long and short options offset each other. However, as the underlying stock price moves, delta can change, impacting the spread's value. Traders keep an eye on delta to see how stock price changes affect their position and to plan for adjustments if the stock moves significantly. Next is gamma, which measures how much delta changes when the underlying price shifts. Calendar spreads often have low or near zero gamma because the long and short options balance each other out. This means the position is less sensitive to quick price changes, which can be a plus if you expect the stock to stay stable. However, low gamma also means you might miss out on gains if the stock moves favorably. Now let's discuss theta, which represents time decay. This is how much an option's value decreases as it approaches expiration. Calendar spreads usually have a positive theta because the short-term option you sold decays faster than the long-term option you bought. This time decay can lead to profits if the stock price stays near the strike price. Managing theta is important since you benefit from time passing, but you must be cautious if the stock moves away from the strike price, as this can reduce the spread's value. Finally, we have Vega, which measures how sensitive the option's price is to changes in implied volatility. Calendar spreads are generally long Vega, meaning they gain value when implied volatility increases. The longer-dated option has more Vega than the shorter-dated option, so when volatility rises, the spread's value tends to increase. Conversely, if volatility drops, it can negatively impact your position. Traders monitor Vega closely, especially around events that could cause volatility spikes, to time their entries and exits effectively. In practice, traders often choose strike prices that are near the current stock price to maximize theta decay and Vega sensitivity. Keeping track of the Greeks helps in adjusting your position, like rolling the short option forward or closing the spread if delta moves to or from neutral or if volatility conditions change. Understanding how these Greeks interact allows traders to anticipate how their calendar spread will perform under various market conditions, including price movements, time passage, and shifts in volatility.